transcribing. So I've started that up. Welcome everyone for joining us here today. We're conducting kind of a rerun of our webinar. And my name is Ryan Porter. I'm with Porter Legacy Group. I am an investor and real excited about multifamily real estate. We've got three other gentlemen on with us tonight. Two from our partners, Iron Ridge Capital. I will ask for Eric Strom to introduce himself next.
Hi, Eric Strom. I'm one of the principals at Iron Ridge Capital. I've been doing this for 24 years, spent 10 years as a broker, started investing into multifamily in my early 20s and started syndicating in 2007. We have done 16 syndication deals. We have done exits on 13 of those, and we've worn just about every hat that you can in multifamily, and love doing it, and we're happy to be here.
My name is Eric Nordstrom. I'm the other principal at Iron Ridge Capital. I started investing with Eric Strom back in 2011 and then joined with him in 2013. Just kind of building owner-operator syndication company and enjoying the ride.
Hey there, I'm Bruce Porter, Ryan's dad. I've had the privilege of building two highly successful careers over the years. The first one in real estate. For over 15 years, I worked alongside my brother Dave Chant in the Pocono Mountain and Hudson Valley regions, advising high net worth clients on purchasing residential, recreational, and commercial properties. And I absolutely loved every moment of it. The second go around was in finance. For more than 35 years, I was a fully licensed financial advisor with various Wall Street firms, including my own. I specialized in tax-free municipal bonds, stocks, and private equity. It was a career I truly loved as well. Needless to say, my real estate and securities investments are in my DNA. I'm honored to bring the expertise I've gained from both those careers to Porter Legacy Group, and I couldn't be more thrilled to do it alongside my son, Ryan. And what better way to kick off things than with SouthCrest Apartments? This investment opportunity perfectly embodies the qualities I seek for my clients: income, growth, tax advantages, and low volatility. Okay, Ryan, now we can maybe hear some details.
Sure. Okay, so we're going to move into our kind of details here about SouthCrest. Just a summary slide here to kind of kick things off. The multifamily apartment complex building we're looking at is called SouthCrest Apartments. It's in Dallas, Texas, just south of the central downtown area of Dallas, Texas. It's a 150-unit multifamily community with a mix of 1, 2, 3, and 4 bedrooms. The purchase price is just south of $16 million. And it's a profitable investment. It's relatively safe. We love the fact that there is a assumable loan that has 5 years left on it. And so that helps us kind of mitigate interest rate risk. So really attractive kind of quality of this deal. We have a renovation plan, a business plan that includes renovating 54 units with a $925K budget. The other remaining units have already been renovated, and the previous owners have invested quite a bit in new roofs and new HVAC equipment and so forth. And so the building's in fairly good shape right now, but we're going to continue to approve it. It did mention the location. It's close to downtown Dallas. There's a university that's right next door. There's employers very, very close. And what we're projecting here in terms of returns is a cash on cash starting in year 2 of about 9.3%, and an annual return of about 23.5%. So those are the highlights, the summary, if you will. We're going to go into more detail about it, but before we do that, we want to talk a little bit more about our partners here at Iron Ridge and their track record over the years.
Yeah, thanks, Ryan. And we're really excited to be doing this with Porter Legacy too. Just to have utmost respect for you guys, and we've been doing it for a long time. This graph represents each one of the syndications or apartment properties that we've purchased. You can see that the yearly returns on these have varied, but if we take the 16-year weighted average, it's 32% a year. So that means that the worst deal we did right before Lehman Brothers collapsed at 14% that we held for 7 years, that gets weighted 7 times more than the 84% 1-year return because we held it for 7 years instead of 1. And these are pre-Great Recession, post-Great Recession, and including the run-up of interest rates that we've had recently. So super proud of the track record, and really excited to add another one to it.
Awesome. Thanks, Eric. So just going into kind of a bit more detail about the property itself, we have the address there. We did mention that it's close to downtown. It's between Highway 67 and Interstate 35, so it's well connected, and you can get to other employment centers, schools, shopping districts. It's got great connectivity. There is other housing there that's close to it, but it's mostly student housing. So this is the only kind of market rate housing complex that's there right now. There are some other complexes that will be going up. It has a strong, stable tenant base, mostly Latino families in that area. The units themselves are spacious. It's ideal for families and professionals. I did mention before, there's been some good work that's done on it, new roof, HVAC. The parking lot's been resurfaced. There's a laundry facility. There's some outdoor grilling areas. It's surrounded by a green belt. So on the back side of it, it's got a wooded area that makes for kind of a really serene, peaceful setting. We're going to add a fitness center and a pet or dog park there. So those are going to be part of the value add process. The rents are a little bit below market, so we're going to have the ability to kind of push the rents subsequent to probably year 2 is when that's going to happen after some of these investments are made. So some detail there are the structure of the asset itself. You can see photos down here that show kind of the exterior and kitchen and bathroom and so forth. We'll move into the value add business plan, and we've touched a little bit on this in the initial slides, but just to get a view of all the aspects here, we'll go from left to right. This is a value add business plan, which is really kind of what we specialize in, what we're looking to do, which is a forced appreciation through value add. And as we mentioned, 65% of the units have been upgraded. We are going to upgrade the other 54 units. There's going to be some enhancements in the in the finishes and flooring and kitchens and bathrooms, fitness center, pet park. So that's the first column you see there on the left-hand side. We believe that there's an opportunity to push rents, and this is a below market rent situation. Dallas right now, in terms of the market there, has had a lot of supply coming on the market over the last couple of years, which has held rents kind of steady and even had them pushed down a little bit. We know that the new supply is going to ebb at this point in time, towards the end of 2025, 2026, because there are a lack of housing starts due to interest rates and so forth. So we're expecting the supply surge to go away and rents to start to push here in the relative short term. In the middle column, we have high occupancy and demand. And so this asset has had a historical strong occupancy rates. We're going to make sure that we do not do anything to upset the apple cart there and change that. We want to maintain that while improving the asset. So over to the fourth column, we have mentioned the loan. The loan is just a great story to this deal. So it allows us to have stability here. Let's see here. So we're expecting 3% rent and expense growth starting in year 2, and then on the far right. The exit strategy is effectively a plan to sell or refinance in 5 years, and the typical hold period is anywhere from 3 to 4 up to 10-year period. And so we're just going to exit when the timing is right, when the market is right. We will have that 5-year kind of impetus to make a change when the loan period is up. So we'll either sell or refinance at that point, returning significant equity back to investors. We're looking at a strong ROI figure there, which makes us feel good and hopefully makes you feel good. Eric or Bruce, any thoughts here as we go away from this slide onto the next one?
My thoughts would be, if you move to these are projections, and they're very, very well thought out. There's a significant amount of data to support them, which is on the next sheet, and the sheet that's kind of onerous in terms of size and depth. But if you flip to the next sheet briefly, Ryan, if you get off this call and you say, I wish I had asked this question or about the rent roll or about the overall expenses, or if you want a kind of a repeat or a review of where we got the IRR of 18.1% or the 5-year ROI of 23.5%, it's all here. There's no magic. This is where they got those projections. So if you're going to do any look back after this call, that's the one I'd go to.
That was one of the things that I really enjoyed about digging into this with Ryan and Bruce, was we really went in detail on this. And there's when we look back at all of the projects in the past, we do take great care in predicting what forward-looking cash flow will look like, and sales potentials. So this will include all of the assumptions. And then, just so that everyone knows too, we stress test every deal with the same conditions that happened in 2009. When we saw that we had a huge increase in vacancy, where we could get vacancy rates upwards of 20%, and we saw an increase in interest rates. And just so that we can sleep at night, we always put those same conditions into the model, and we stress test it so that we know that if things go wrong, that we can survive it through that recovery period. And we live in that spreadsheet, and it's an exciting spreadsheet to live in right now.
Agreed.
Awesome. Thanks, guys. So the following, these next 2 slides are effectively blow-ups of certain sections of the previous more detailed slide here, and so it just allows us to kind of dive a little deeper in specific areas. So we're going to focus right here on this financial overview, which is year two, and really this is the first year where we're expecting to pay a distribution, and that distribution is looking at about 9.31%. And you can see the numbers that make up that, where that calculation effectively comes from. On the right side, we are showing a return analysis for both a 5 and a 10-year hold period, with an example amount, an investment amount of $250K. So just to kind of simplify things here, a $250K investment over the 5-year period is expected to pay $105K total of distribution starting in year 2 going through to year 5. And then at the sale of the property, the proceeds of that would be approximately 440K. And so the total money received over that period is looking to be close to 550K, effectively doubling your original investment there. So that's what it's looking at a 5-year period. And then we have the ROI, the IRR, and the cash flow percentages there. In the right-hand side, we have the same kind of projections over a 10-year period. So that's what we wanted to kind of blow up and show you on this slide. I'll stop there again and invite any comments from the team.
I think the nice thing about this one is if you look at some of the numbers where you've got like a vacancy and delinquency at 9%, the building right now is operating much better than that. You're between 5 to 7%, but the same thing, we want to go into it conservative. And then on a lot of the renovations that they've currently done, they're already getting the upside of rent levels that we've projected. So you have a real nice combination of, proven upside that they've proven out the rents they can get with a renovation, and then a huge de-risking on that interest rate with the loan, because that is such a burden in today's market. So having a 4.6% interest-only loan for the next 5 years, takes a lot of the guesswork and the risk away from an investment in what is perceived as a pretty weak market right now because of those interest rates.
Awesome. So we'll move on to this next slide, which is basically the sources and uses of funds. Up here, you can see that the purchase price that we have is about $15,750,000. And then we have various costs and fees related to legal work and the remodeling and so forth. And that takes us up to about $17.5 million. Those are the uses of funds. And then where the funds are effectively coming from, we've talked kind of a lot about the loan. The loan that we're assuming is close to $11 million. And then we're going to be raising capital to fund these two line items that you see here, which is the renovation and the equity portion, which is about $6.5 million. So you see the source of funds there. I will move on to the next slide, assuming no further comments in regards to these. I think this is pretty straightforward here. So we're effectively just kind of rounding back out to the summary that we started with. The location, Dallas, Texas. That's basically where we're operating. A nice size building with a good distribution of layouts there. Really a big highlight, as Eric just mentioned, is the loan, the assumable loan. The fact that this is a structure that's already in good shape, and the previous owners have made solid investments in it, and we're going to continue that aspect. A location that is south of Dallas, which is very close to downtown Dallas. It's about a 7-minute drive. We drove it yesterday, and yeah, with no traffic, it's right there. We've talked about the returns here. We have strong returns that we're forecasting. This is conservative underwriting, and we will move on to the next slide. Anything anyone wants to say here at this point? Just kind of a quick summary.
I would just ask for a little bit of a blow up, if you will, of why Dallas. I know the answer myself because you guys have told me that, but it might be nice to hear from one of the Erics as to why Dallas.
We love the Dallas market. We didn't, originally we were investing in Washington State, 20 years ago. And, eventually we decided, okay, where are we going to spend the next 30 years of our lives and buy apartment buildings? And that led to a nationwide search. And when you look at the in-migration of people, the in-migration of jobs, business-friendly culture, and the in-migration of capital, it's a really, really attractive place. It also, has the critical mass where there's, 1 million units of apartment homes. So, you've got the velocity to have an active market in terms of buying and selling. So when we're done with this, there's going to be somebody that's going to buy it too. And you get a lot of attention coming from the coastal markets where you see a huge amount of capital coming out of New England and the West Coast searching for yield. And it's really easy to affect the business plan because we don't have a lot of the regulations and laws that you have in those coastal markets, things like rent control, any barriers to increasing rents, and turning over a tenant base. So the value add model works very well in Dallas, and macroeconomically, it's a very strong market that only seems to be getting stronger.
Awesome.
How do you feel about all those people moving in from my two states, New York and California?
If they bring in their wallets, they're welcome to come.
Awesome. I think this would be a great point for us to go through questions that we've had in previous webinar about this. And so I think I can queue them up here. So, great question from Gary was, why is the previous owner selling?
And so the previous owner, we actually know them quite well. It's a family, good relationship with them. And, over the last 3 years has been a very difficult time for new acquisitions on apartment buildings. Because, typically if you bought in 2020, 2021, you went into a project at a 4 to 4.5% interest rate. And if it was adjustable, which a lot of the bridge debt was, your interest rate may be 9.5%. Long story short, that means that when that bridge note is due, you have to bring money to the table either to sell or refinance because the cost of ownership and the cost of that leverage went up. So you've got a huge amount of owners nationally that are underwater on anything they purchased in the last 3 years. Owner was no exception to that rule. They've got 2 projects that they need a major influx of capital on, not the SouthCrest. And the SouthCrest is the building that has all the equity in it. So they're selling this to harvest the equity and plug some holes on 2 other deals so that they don't have to, give the keys back to the bank. So it's a distressed situation, but not a distressed building.
Great. This was a question from Patrick. What are the risks or the downsides to an investment like this?
I think the major downside to these is that it's very forgiving in terms of timing. And it's a very stable asset. So multifamily, brick and mortar, everyone needs a place to live. It's always been considered, kind of a lower risk, mid-tier return. We operate within a niche of that niche, which is the value add space. So for every $100 that you increase rents by, you increase the value of the building by $20,000. Multiply that $100 increase by 100 units, you've created $2 million just by raising rents. Now the downside to answer the question, is that it's not liquid. It's a highly illiquid vehicle as opposed to a stock, where of course there is an opportunity if you have a life circumstance, to have the partnership buy you out or to sell to somebody else. Your money is just tied up for a longer period of time, and you can't click a button at 2 o'clock in the morning and sell your position.
Yeah. Great.
Ryan, I know you have more questions, but it would be a good opportunity for me to talk about a comparison of this investment to the other three major investments that we all know about. And one would be bonds. And this investment is reliable and it has a higher income. This is 10.3% annual yield. And the current, as an aside, the current 5-year yields on a municipal bond is around 3% for a AA bond. And a corporate bond, if you go in the middle of the ratings, is around 5%. And the U.S. Treasury is around 4.3% for a 5-year hold, probably less than that for a 10-year hold. It, in my opinion, is stronger than stocks. 23% projected annual appreciation, outpacing the stock market returns. I mean, trailing 5 for the S&P is around 13.5%, and the long-term average of the S&P is even less than that, of 9 to 10%. And this vehicle has very significant tax advantages, and I'll highlight them, and then perhaps Eric Strom can elaborate on them. And that's depreciation deduction, pass-through tax treatment, and capital gains treatment that are very, very much advantageous for the investment. And of course, they are particular to the total portfolio of whoever's owning this particular investment.
Yeah, we've had a lot of investors in the past that were very tax driven because they had high gains in other areas. I will say that the disclaimer that I'm not a tax professional, so consult your CPA.
Absolutely.
But what you get with multifamily is you get 27.5 years of straight line depreciation for the physical building and improvements on any property. And, so if you take something, like SouthCrest, you could take, 80% of that $16 million that we're purchasing it for would be the building portion, divided by 27.5. And that is your yearly write-off that the partnership gets to take. Now with this project and with most projects that we do, we'll do a cost segregation study on it. And that takes and it accelerates the usable life of every component of the building, where you get a larger write-off in year 1 and 2. Now it's going to vary on every project, but those range anywhere from 30% to 50% of initial investment on the last few deals that we've done has been what the year 1 write-off has been. And if you are talking with your CPA, talk about the difference between passive and active investor status. Because if you do have active investor status, then you can write that off against all forms of income. If you're passive, you can write it off against all passive gains. But it's a huge advantage to investing. It's kind of what keeps a lot of the multifamily guys coming back, and how they avoid paying Uncle Sam too much money at once.
Awesome. Another question from Eric was about the replacement costs. What do we estimate the replacement cost to be for a building like this?
It's going to range, anywhere from, depending on suburban to urban, but you could be anywhere from $200 to $340 a square foot. SouthCrest, we're buying at, I think, $113 per rentable square foot. So it's way below replacement cost. And, to your point earlier, Ryan, talking about the supply cliff that we're on right now, where, construction starts are, pretty much non-existent. It's because of that, is that to build something new, it costs a lot of money, and then the debt carry on it's very low. So this is really well positioned. to take the rebound as, absorption and demand has not stopped, but, we get past 2025. And like you said, there's just no noticeable construction starts. So that's supply and demand usually equals rent growth.
Awesome. Got it. And this is the last question. I don't remember exactly who posed this question, but it's probably the best, most important question. And that was, when is the subscription docs due? When will the subscription docs be ready? And when is the money due? And maybe I'll just take that one. So we are working on the subscription docs right now. We're expecting to have them at the end of next week. It's currently February 22nd right now. So we're looking at about a week from today on that, and then the money is going to be due effectively 1 week from that date, which the current forecast is March 7th. And so those are the dates on that. We're going to have the docs available in our investor portal. It's going to be a relatively easy process to subscribe and sign online, and then we'll have a place where those funds can be wired, and we are working hard to make that as frictionless as possible to get this process started. So I will move on to the next to last slide here, which is in line with that last question, and it's effectively, what is the investment opportunity, and what are we looking for? And so we're seeing a typical investment around the $250K range. We cannot go higher than $1 million, and the minimum that we're looking for is about 100, although that's a flexible number. So we'll be in touch with communications coming over email, and Bruce is following up with folks that have been on the webinars. And I will go to the last slide, which is just basically our thank you to you for your attention and attendance, and we welcome any further questions or inquiries. I'll also note that in the back portion of this deck, there are the biographies of the four of us there, so that you can just see a little bit more about our history and what we've done in the past. So any closing thoughts from the team?
Yeah, I'd like to add, we are owner operators who are vertically integrated, so we will be managing the property. We learned early on in our career that to have full control over operations, we needed to manage the property. Over the last 17 years, we've been managing our properties for the last 14 of them, because we quickly found out that other management companies, they focus on what they get paid on, which is top line, and that doesn't drive, it's not the only equation to the NOI. So, we look at everything, not just top line, but expenses as well too, because we know that the NOI is what drives the price of the building. And that's been one of the reasons why we've had the success over, as you saw in our track record, is because we have had the control of those operations, which allowed us to be nimble and allowed us to make decisions that are data driven.
Yeah, as one of our investors has said, it's not the horse, it's the jockey. Although I really do like this horse. It's a big horse. And Ryan, gosh, we've been talking for a long time with you, and kicking the tires on stuff and looking at things, and having been sitting on the sidelines for the last 3 years until we find a deal that really works. We're excited to do this with you and Bruce, and it's really the ideal thing that we've been looking for. So this is exciting, and I can't wait to go get to work with y'all.
I just have one thing that's relative to pretty much any investment, and it's just under the title of communication. Communication is everything, in my opinion, when I've given someone else my money. So I believe that Ryan and his tech team have built a state-of-the-art client relationship management system that will be utilized to disseminate updates relative to the overall progress of the project, the quarterly distributions, and the very important year-end K1. I mean, generally, I just think that the customer relationship management that we have is, in my opinion, equal to that of any large brokerage firm, with the added bonus of easy accessibility to, a real person, and via telephone, text, or online, or in the customer portal. So.
Awesome. Thank you. I think we'll wrap there. I think that's a good point to wrap things up. Thank you, everyone. Cheers.
All right, thank you.
Thank you.
Thank you.